Hello, and welcome to Freedom One's next installment of the 8-Minute Update on our continued theme of Protect, Prepare, and Recover. I have with me today Roberta Angelo, Vice President of Client Relations here at Freedom One.
Thanks for including me, Chris.
Oh, thrilled to have you, Roberta. Today's theme is We've Discovered Gold. What we're going to do today is to look at how Freedom One determines what the most appropriate mutual funds to put in our portfolios are. So that really, we've got to back up. There are really two jobs that we have here at Freedom One. First is portfolio allocation. That's how we determine what types of funds and what allocation versus stocks and bonds and cash to put into the different maps. The second and more difficult job is to determine exactly what funds to put in there. How do we populate those? We can do that in a number of different ways. One is to just keep the current funds that we have, which are reaffirm that we like those funds. The second is to go through and look to see, are there different asset categories? For example, should we have real estate or some other type of fund in there that we don't currently have, or should we reduce one? And finally is to monitor any mutual funds that might be on our watch list. When a stock goes into our watch list, that's normally because for one reason or another, and typically it's either performance or management changes, we found that it was no longer appropriate. After the stock is on the watch list, we'll determine, after management interviews and extensive amount of work, to either hold, reduce, or sell that fund.
You know, a question that comes up a lot, Chris, is there a set number of weeks or months that a fund will remain on the watch list before action is taken?
No, there is no set amount of time. What it is, are they progressing towards how to fix that? For example, a different fund, we might be concerned about something with management or something with short-term performance or even something that's out of their control. For example, if you remember, we talked about Loomis Sayles a while ago, that Loomis Sayles, the bond market went out of whack on them. It all depends on what's wrong with that fund. So a fund sometimes might not even get on the watch list and we want to remove it. And there are other times that although disappointed a fund is on the watch list, it's not reason for termination. One of the funds that we have is a fund that was put in place. It's called Keeley. Keeley has a small cap value fund. Very, very good fund. They're experienced and well-respected management team. The way in which they manage money is fine, and they have very impressive returns. The concern that we had with Keeley is that their recent performance, and especially their relative performance compared to other managers that do the same things, they've just been subpar. Unfortunately, we've gone out and visited with Keeley. We've had numerous calls and visits face-to-face with them. The problem is that they will, what's referred to as, have sector concentration. Where Keeley really did very well is they had an awful lot of money in energy stocks, but when energy stocks fell and commodity prices fell, they got caught behind the eight ball a bit. And it doesn't mean that they're a bad fund in any way. They're just more volatile than what we want in this conservative type of movement. So we decided to do a fund search. So from a very comprehensive standpoint, we went through and looked at all the different funds out there. There are a couple reasons that we would do this. For example, with Keeley here, it's a fund replacement. There are other times that if we're going to change our theme, for example, when we go from phase 1 to phase 2 in our Protect, Prepare, Recover, we may be adding or deleting certain managers because our theme will have changed and the types of managers we want. And finally, we may add or delete a different asset category. This case, we're doing a fund replacement. So what we're doing is we're trying to look for a new small cap value fund.
Before we go too much further, why don't you back up and remind us what small cap value means?
Good question. First of all, these are stock funds. These are mutual funds that invest exclusively in stocks. Now, as the name suggests, small cap, what small means is that it doesn't mean they're a small management company. It means they're buying smaller companies. And the way in which they define what a small company is by looking at what's called a capitalization. If you took the amount of shares out there times the value of the shares, if the company has less than $5 billion in stock out there, they're called a small cap. So that's what a small cap manager is. When we reviewed all the different managers out there, we found that there were 37 small cap value managers out there. So that was a good place to start. We had plenty of funds to select from. So we started with 37. The next thing we did is we went through and we start with what's called a quantitative research. This is pretty simple. These are just statistics. What we do is we'll either call the management companies or we'll look on different data sources to come up with how the fund is run itself. So, for example, we want to know how long the manager has been in charge of that, what their expense ratios are, or something as simple as how's their performance been.
So when you say expense ratio, I know you mean that's the cost of the fund to the investor over a 1-year period of time. What was Keeley's expense ratio?
Well, Keeley's expense ratio was 1.36. Now, what that means is 1.36% on an annual basis. The average mutual fund is over 1.5, so Keeley was below. Now, before I spill the beans on it, the manager that we're selecting is actually at 1.08. So not only did we find a manager that we thought was more suitable, but also was about 30% less in management fees. So it was a win-win from that situation. Well, when we did this quantitative research, we came up with 19 managers. We then do what's called a qualitative research, which is more the warm and fuzzy type things. We've got to go out and try to come up with how this manager actually runs the fund. And so that has things like how do they comply with their own internal controls. We want to make sure that their style is consistent. And, one of the more important things, we want to make sure that we have actually that management is responsive to what our needs are.
Why is it important for management to be responsive to us?
Well, what we want to do is to make sure that we're not just talking to the salespeople. We want to talk to the people that are actually making the decisions. You always get a little more sincere and a little more direct answer from the management rather than just from what's the approved sales language. Of the 19 funds that passed our quantitative, the qualitative 8 passed. What we then do is we do a detailed research. That starts off with a written questionnaire. And it depends on the different fund category, how detailed that questionnaire. With small cap value, it was quite extensive because it's a pretty specialized type of management. We'll then take and have conference calls with those. Out of the 8 funds that we did the management questionnaires and conference calls, 3 of those really we thought were the highest quality. And so what we did is we got on a plane and went out and met with them face to face. We thought that was very important.
Well, that screening process seems really extensive. How many hours does it take to complete a search like this?
Well, I wish we could measure it in hours, but it's not. It's measured in weeks. With response to this one, it was better than a month-long process from beginning to end, and that was moving fairly quickly. We were very pleased with the timing on that. The next thing we do after we compile all that information is the investment committee gets together and we review all those findings that we had, whether that was qualitative and quantitative in the written and the conference calls and the face-to-face meetings. And our idea there is we had 3 very qualified candidates. I'm not sure we could have gone wrong with any one of the 3, but what we found is really we had one that stood out a little bit above the others. And I'm pleased to say that it was Goldman Sachs Small Cap Value Fund. Goldman Sachs is a name I think most of us are familiar with. They're a large, well-respected financial institution, and we just found that their mutual fund team was about as good as we could find, and we were very pleased with all the things they had to say.
That's great news.
Now, Roberta, the investment team has got their part done, at least on the selection of this. Can you help out? I mean, how is it we go through and actually change the funds over in the different accounts?
Well, good news for the investor. Investors don't have to do anything. We send paperwork out announcing the change, receive approval from the plan sponsors, and then go ahead and make the change automatically. And those changes are starting this week and will continue on over the next couple of weeks. And then everybody will be moved out of the Keeley fund and into the Goldman fund automatically.
So this is hands off to the investors?
Completely hands off.
Perfect. Well, that's this 8-minute update. As always, if you have any ideas on future 8-minute update ideas, we'd love to hear from it. The best way to communicate that with us is if you would take the survey at the end of this. We sincerely appreciate the prior surveys you filled out, and they have influenced our topic selection in the past. So once again, thank you, and look forward to seeing you at the next 8-minute update.